Greetings, folks. Today I'm just having some fun and wanted to talk finances, financial independence, retire early, and talk about one of my favorite investments. And there's something out there called the 4% rule that the fire community uses a lot that says, hey, if you get enough in assets that if you take 4% out of your assets every year, you can live off those investments and never run out of money for any 30-year period. And so the 4% rule is pretty well known out there in the community. And so the problem is that enough for the expenses that most people have to just live off 4%, you might need $2 million or $2.5 million before you have enough to be able to live off those investments. And they're also typically investing in the S&P 500, and so that requires that each year they sell some of their investments. The S&P 500 does pay some of a dividend. It's like 1.3% or something. So you get 1.3% of a dividend, and then you sell another 2.7% of your funds, and that gives you your 4%. Well, what if the rule wasn't the 4% rule? What if it was the 9% rule? I like that a lot better, because if you're able to withdraw 9% from your funds every year instead of 4%, well, that gets you to you need less assets in order to retire early or to live off your investments than you would if you're just pulling 4%. But 9% sounds really scary. You're like, well, your stock values will go down if you do the 9% rule. Well, perhaps not. So here's an interesting investment to take a look at. There's a company called Western Midstream, and the ticker is WES. You can purchase it like a stock, but it's not actually a stock. It's called a master limited partnership. MLPs are something you can also purchase. They're out there, they're liquid, you can buy and sell them just like stocks, but they're slightly different. Instead of buying shares like you would in a stock, you're buying units. And then each unit throws off some income. Now I will just say that if you own a master limited partnership, you're going to get a K-1 tax statement every year that you have to enter into your taxes. And there's some different rules that you're going to need to be able to deal with. But in most cases, a K-1 statement can be handled pretty easily on your TurboTax or H&R Block software. I've done this successfully for the past several years, and it's not that big of a deal. There are some oddities that you kind of have to worry about, or be aware of, but it's not that bad. But to me, it's worth it to be able to gain the high passive income. So what's so interesting is Western Midstream has a distribution yield right now, as of today, of 9%. So what that means is every year, based on today's share price, they're going to passively pay you 9%. So basically that means you never have to sell a single share that you own of Western Midstream. You're just going to collect a 9% passive income stream year after year. Now, I gotta say that they don't pay as a ordinary dividend, nor is it a qualified dividend. This is called return of capital, which is also interesting. It actually has some great tax benefits, particularly if you're working in a high income field. If you get qualified dividends, if you earn enough, you're going to get taxed on those. Ordinary dividends, you get taxed at ordinary income rates. But return of capital is different, because basically the company says, you gave us a bunch of money, we're going to give you back your money until we've given all of your money back. And then at that point, then you get taxed on any extra income. So what it does is it slowly lowers the basis of your share price, but you're not taxed until you've recovered 100% of the money you originally gave them. So it's really a fascinating type of investment, where you invest in a company, they give you your own money back at a high yield. You don't pay taxes on it until they've given all of your money back. If you ever choose to sell these investments, then you can have a higher tax bill, because it's like you've got 100% gain. So just be aware of that. But a 9% yield is really, really cool. And the idea is that your notional average value, or your NAV, also doesn't increase. So like if you go out and get a covered call ETF or some of these yield max strategies, they have higher dividends, but the price of your shares is really tends to go down or is volatile, and so this pipeline stock has the ability to actually have an increase in your NAV or your per share purchase price, while also getting a high 9% dividend yield. So I've been an owner of Western Midstream for the past couple years. The dividends have just come in every quarter. They're high. Right now I'm just repurchasing shares, so it's been a nice way to just acquire more stock. But in theory, I can just own Western Midstream for decades. They pay out 9%. The share price should increase as long as the pipelines stay valid and worth something. It's kind of like the best of both worlds. Now, right now with the big AI revolution, there's folks that are saying pipelines are a really good investment to be in because natural gas is, they call it the bridge fuel before we get to more nuclear power, and we need natural gas to be able to power the data centers that AI runs on. So pipelines are what push natural gas around, and so all of these energy producers and energy midstream companies potentially could have a nice gain because of the need for AI infrastructure and electricity. And basically, I guess, is if the economy continues to move, everybody needs more energy for everything, whether you have your electric car or more digital devices, and natural gas is the way to do that. So this principle, or this idea, who knows, if we get a bunch of nuclear reactors in 10 years, this might not be as good of an investment, or in 20 years or 30 years, who knows how long it'll take for us to do this. But the assets that the pipelines that Western Midstream have should continue to be worth something. They have contracts where inflation is baked into their contracts, so as inflation goes up, the producers have guaranteed to the pipelines that they'll continue to pay a higher rate to push oil and gas around. They pay a really high distribution that's been fairly stable, and you can look up past dividend history to see how has this company performed over the past while. Did they increase their dividend? Were there any dividend cuts? But if you're getting a 9% dividend yield, I'll call it a dividend yield, it's really return on capital, well, then you can retire early, because instead of the 4% rule, you have the 9% rule. That means you need a whole lot less. So if you saved $1 million, 9% is $90,000, and that's enough for a lot of people to live on in this country. So instead of $2.5 million that you need to acquire, you only need $1 million. Or if you're trying to grow your income every year, getting a 9% return plus some appreciation in your share price, that's a really great way to increase the value of your investments. So instead of the 4% rule, what if you could have the 9% rule? I like the 9% rule quite a bit, which is why I do own Western Midstream Partners, as well as all of the other master limited partnerships. I own them all. They're just fascinating investments, but I like the 9% rule a whole lot better than the 4% rule, and that's one of the reasons why I am an investor in Western Midstream Partners. Again, the ticker is WES. It's a master limited partnership. You get a K1 statement every year that you have to put into your taxes, but it's not that big of a deal. So check it out. It's not financial advice. Check your own tax advisor or whatever, but just trying to share some of the things I've learned with you that maybe you'll get something out of this, and it'll help your own financial independence journey. So cheers, like, subscribe, we'll see you.